Nitin Rakesh, CEO and Managing Director at Motilal Oswal Asset Management Company, is with us right now to talk about his thoughts on what's going on in the marketplace. Nitin, good morning. Good to have you. Prashant here. 51-point surge out of nowhere, 55.37 on the Nifty. You want to start with that? The index itself?
Sure. Actually, a lot of that surge happened while I was on my way to the studio. But I think, over the last few sessions, we've seen volumes kind of dry up a lot. So, very small buying or very small selling is going to swing the markets in either direction. I think so. What we're seeing right now is potentially a reaction to some sort of institutional activity for the lack of depth right now. So I think, that's probably what you're referring to over the last few minutes.
Nitin, do you have a definitive call, say 6 months down, this is where we will be, we'll be 20% higher, we'll be 20% down, so I should buy now if the market is going to move up substantially, or I would be a buyer 20% lower? Do you have a call?
I'll just give you the way we are looking at the market right now, and effectively, while we are focused on what's happening on the overall index level, I think it's at this point the play is much more individual stock level. What we've seen is the markets at an index level is consolidating between 5,400 Nifty to about 58, 59 on the upside, and within this trading band, anytime it goes to the upper end of the range, you see a sharp fall. Anytime it comes to the lower end of the range, you see sharp spikes. There is no trigger right now for the market. We had the interest rate hike that triggered the fall. We now have the commodity price crash globally that's triggering this little bit of rise and cushion on the bottom side. So again, it's very hard to call whether the market's going to be 20% higher or lower. There are a few factors at play, most of which are linked to global liquidity, commodity prices, and in turn reflecting in our local inflation and interest rate scenarios. So I think until we have a very clear picture on the interest rate cycle peaking out, it's very hard to take a call on the overall market direction being up or down. What we definitely know is that, thanks to the volatility globally and the liquidity pressure that will come post ending of QE2 on June 30th, you'll definitely get opportunities to kind of buy great companies in the market at nice valuations. And I think examples being, what we saw with companies like SBI or Hero Honda a couple of days ago, or what we are seeing with some of the other banks today. So I think in the longer run, the interest rate sensitives are probably the best place to be in, and the opportunities that the market will give us will be used to kind of accumulate positions in those.
Oh, you wouldn't question the underlying bull case for Indian equities, say from a 2-year perspective, because of high interest rates? You wouldn't do that? You wouldn't go that far?
Absolutely not. I think a large part of the interest rate problem or the inflation problem is not very specific to India. I think almost every emerging market that saw very large capital flows in end of 2009, 2010 is suffering from the same problem. We've been behind the curve in controlling inflation, whereas some other economies have actually got a little better grip on that. But I don't think the overall long-term growth picture has actually taken a beating. In the short run, maybe for the first 2 quarters of this financial year, we may see an impact on the earnings, as we've been seeing over the last couple of quarters as well. But I don't think that questions the overall corporate profitability cycle at all.
Could you would you agree when I say again, going back to interest rates and high interest rates and inflation in the system, that consumption related plays might see which have been the darlings of the market might not be the favorites anymore for some time? Because of what we are seeing right now. Because what the RBI is doing is essentially,
I think a lot of that is already in the price, because as you know, we've seen a little bit of a softening in automobile volumes. We've seen a little bit of impact on the margins anyways coming up because of high raw material prices. But I think the inherent consumption story doesn't really end. It may actually consolidate for a couple of quarters, as I mentioned. But from our point of view, I think this is an opportunity. People who wanted to get into these space couldn't get in because valuations were pretty stretched all through 2010. So I think this is the opportunity, looking at the next 2 years, to kind of build positions in interest rate sensitive, especially banks and autos.
Okay, so essentially you're saying it's basically postponing consumption but not destroying consumption. The high rates that we're seeing right now.
The inherent tailwind to consumption is going to continue to be there, because at any point in time with the expansion in economic activity and per capita GDP, it's not something that is unique to India. We've seen that happen time again in other economies, and I think we will continue on that path. The question really is, do we achieve that in 3 years or 4 years or 2 years? And I think we've basically seen that little bit of a consolidation over the last couple of quarters, but that's primarily because of global liquidity issues. So I don't think the consumption story needs to be questioned at all. And I think what we are really looking at is that if there is a deep cut in the market, and if for some reason it does go below 54, or 100 levels, I think that's really the perfect opportunity to then build positions in these sectors.
Nitin, we were having this chat earlier here before the markets opened about what will happen if commodities come off significantly. Say, the entire basket takes a big cut of about 25-30 points, 25-30%.
Yeah.
The general way to look at it is that India will be greatly benefited, equity prices will break through the previous highs, etc., etc. Is it going to really happen that way? Do you believe that? Because at the end of the day, liquidity is fungible, right? If commodities crash, it will lead to a lot of destruction there, and a lot of that flow which people are talking about might not make it here. In the longer term, yes, it might benefit, but near term, we might just go down along with the commodities market.
Exactly. I think in the very short run, it's anybody's guess whether we'll be going down with the global commodity burst or we are going to continue to go up because of the benefits that we get. My inherent sense is there is a higher likelihood that we will drift down with the selling that will happen because of liquidity, sucking out of the liquidity flows. But I think again that's the opportunity that long-term investors like us are always waiting for. So I think in the long run, there's nothing better than commodity pricing cooling off for our markets, our economy, our corporate earnings, our demand and consumption. And I think in the very short term, if that leads to a cut in the market, I think that's probably the godsend opportunity before we see previous highs being taken out.
All right, got that. Nitin, always a pleasure chatting with you. Appreciate your time. Good to get that perspective. Thanks very much. That's Nitin Rakesh at Motilal Oswal Asset Management Company.